Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey Fleck here, your host for this weekend show. It's a packed hour where I am going to be focusing more on really markets broadly. We're going to talk about a lot of different sectors, U.S. equity markets, currencies, and commodities with a couple of my favorite traders. Starting off with Rick Bensignor. Rick is the president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That's read by some of the most successful hedge funds in the world. And on the retail and individual side, check out the In the Know Trader website. I'll post a link to that website in the show notes. Rick has two products, a weekly report called the Tactical Trader Report and a daily report called the Daily Tip Sheet. All of these keeping you abreast of where Rick sees opportunities in the markets, in a wide range of markets. Just on another note, be sure to check out our website, podcast, and subscribe to us through your podcast player and on YouTube to keep up to date with all our daily editorials covering daily market moves and company updates. A lot, again, coming at you this week. Rick, let's start off with U.S. equity markets. Look, Liberation Day, that was the last time we chatted, was shortly after Liberation Day when the markets went through really a waterfall decline. It hit pretty much every sector and every market. Since that time, this last month, just over a month of trading, has been very strong for markets. The S&P back to pretty much 6,000, all-time high, 6150. We're so close there. Even the NASDAQ has had a strong rebound. It does seem like a lot of the trade talk has completely changed. Instead of more tariffs, higher tariffs, we're hearing about deals. Whether you like these deals or not, whether there's substance around them, that whole narrative has changed. So, Rick, what's your take on the strength of this rebound, especially in U.S. markets?
Well, it's been a very impressive rally for sure, and we've recouped almost the entire decline. But I got to tell you that right here and right now, with spiders in the low 590s, I've actually got a counter-trend sell signal right now that at a minimum would suggest it's high risk to first put new capital to work here or now on an index level, right? So in S&P 500 terms, buying now comes with more risk than any other time since the lows were made. And that's not just because we happen to be on the highs, but it's because where we are in the scheme of things with the models that I look at and put a lot of credence into. So I'm not buying anything up here. I'm actually been trimming over the last several days. And I don't think from here you really need to risk much more than 1% or so on that idea. And that doesn't mean if I sold out of a stock today or lightened a long that I had on, that if the S&P moves up 1%, I go replace it and put it right back on. But it says from a risk reward point of view that this isn't the time or place to be buying. And it wouldn't surprise me at all if next week we get a pullback and, we get into, let's say, we fall 15, 20 spider points. That's 150 to 200 S&P points at a minimum, just to kind of correct some of the unyielding strength that we've seen since the lows were put in. And the same type signal that's showing up now to suggest potential upside exhaustion is the same signal that came in one day after the low. So on April 8th, the signal came in that the exact opposite, selling S&Ps under spiders under 600 would have come with inordinate risk on the sell side. And that's exactly what we're getting now on the upside, and saying that the risk is high to first be a buyer here. So in the grand scheme of things, the lows made hit all the key targets that we had talked about well before they ever got there. And you and I talk about once a month. You and your listeners know that I had long talked about the low 480s for spiders as being the downside target, and the low of the entire move was 481.8. So, a perfect kind of low came exactly from both timing models, measurement models, momentum models, everything that we look at got below, including sentiment, which in S&P futures had fallen to 10% bulls at the low. So, to me, I have said the low was in, the high was in, and I didn't have any particular reason, given the known fundamentals, that we would take out either side of both the high and the low made this year. And obviously, with us trading, S&P, let's call it Spiders 592 right now, we're a heck of a lot closer to potentially making a new high than we are to a new low. But for now, I'm going to kind of stick with that and say we've got the range in, and it's mostly range trading at this point. And unless Spiders got above, I don't know, 615 for a few days or something like that, I think that the high at 613 is a good enough reference level that we don't make any new high by any material way right now. Now, with President Trump being who he is, and how things can change on a dime, that of course can change at any moment. But given the known news that we have, I think this rally is due for a pullback. Not enough to go take out the lows. I'm not sure we'd even get an opportunity to fill. There is one unfilled gap on the chart somewhere around 530 or so in spiders. I don't know if if there'd be enough weakness to get down there. I tend to think not at this point. But objectives were met on the upside. And I started telling your listeners from, I guess it was either summer or early fall last year, that spiders would top at 609 and then get a minimum double-digit percent decline. And we ended up getting a 20% decline. And I identified 3 weeks before we got there where to do the buying in the low 480s. So we've called the high, we've called the low, and I'm saying right up around here is probably a place to consider putting on for those who like to trade a tactical bearish bet, either using options or just shorting spiders or doing something like that.
It is so crazy to think about the markets at all-time highs in mid to late February, dropping to lows from the beginning of 2024, giving up all those 2024 gains just into the beginning of April. And now we're halfway through May, and they have taken back all of those gains from 2024. This is crazy volatility that we are seeing. And I do see a relationship between the S&P and NASDAQ, the tech sector, in terms of the strength. The small caps have really lagged this bounce. What sectors are you seeing as being the strongest out there? Or on the flip side, which ones are the weakest in your eyes?
Well, surprisingly, industrials right now have the best trend for both outperformance and positive momentum. And that's a sector that generally, over time, is nothing more than an equal weight because it's such a diversified sector that as one part does well, another part does not so well, and it tends to even out over time. So you don't generally make a lot of alpha being in industrials, but right now that is the sector out of the 11 macro sectors that shows the best combination of trend of outperformance and trend of positive momentum. A lot of the cyclical sectors that had been doing well have dramatically lost upside momentum, and some of them have even lost over the last few weeks the ability to outperform. Names like, energy, healthcare, which had done well and now all of a sudden are looking terrible. And obviously something like United Health has changed the whole healthcare XLV ETF performance. And then let's take a look at what had been prior leaders, which were the three macro sectors that comprise the Mag 7 names, XLK, XLY, XLC, which for those who don't know, that's technology, consumer discretionary, and communication services. Those got slaughtered, and now they are continuously less bad and starting to be, how shall I say, they've reduced their negative bias enough so that all the downside momentum and the underperformance is starting to unwind. So they are at least starting to pick up. So they're getting more towards an improving type situation. But it's a mixed bag. Financials still hang in there. XLC is the one Mag 7 sector that's doing better than the other two, but it's lost a heck of a lot of upside momentum, and that's Google and Meta. And they've both been, with some negative headlines in the last several weeks, and even that's been a tougher play. Obviously, Tesla and Amazon have done very well. Tesla is now over $100, maybe $120 off of the low of the move. So in percentage terms, it's recouped dramatically well. And so I'm not saying I'd necessarily buy them there, but the Tesla bottom, I believe, is it got down to 220. We're now trading, I don't know, 340 or something like that. That to me has seen the worst that it's going to see. And you want to be a buyer of that. And it looks like Amazon went through also about as bad as it's going to get and has recouped. So I tend to be a buyer of that. And look, do you know a single person who doesn't constantly shop on Amazon? I don't. Everybody, look at my neighbor's doorsteps every day, and they're just boxes of Amazon stuff all the time.
Well, Rick, I have kids. You don't want to see our doorstep, man. It's
Yeah,
every day.
it's like exactly. So, that I think when you put that together, XLY is a place you do want to have some exposure to also. But a lot of the prior cyclical leaders have lost their momentum and are actually now not even outperforming.
Interesting. Rick, one other thing that I like to do is look globally as well, because as strong as this rebound has been in the US markets, I've been following European markets very closely because I've been hearing that whole narrative that European markets have lagged so much. In all fairness, their rebound after Liberation Day has actually been stronger than the US markets. What's your takeaway from that environment?
Well, I actually tend to agree, and I am thinking that both. So the proxy I use for European stocks is the ETF with the ticker FEZ, FEZ, like zebra. And that's essentially their Dow Jones 30. It's 50 stocks. It's the Euro 50, the Euro Stocks 50. It's the best 50 names in Europe, and it has done very well. And it's close to a breakout so let me see. Let me just pull this up for a sec. So we are on the yearly highs right now. The all-time high in this name is about 66. This is now at about 55 and a half. And I think if we get above another buck or two higher, this thing's going to move and be a price leader such that Europe it doesn't last long, but there are periods of time that Europe can outperform the US. And I think right now is one of those times that we're going to see it.
Okay. Well, interesting. We'll see how long that outperformance could last too. But again, so much of this is correlated and dependent on what goes on the trade front and really how other countries, other investors view the US. Let's also talk bonds because the 10-year, it has rebounded this month, entered the month right around 4.1 to 4.2%. Now it's just under 4.5%. Still, when I look at it, it looks very range bound to me. A whole lot of indecision looks like it's going on within the bond market. What's your takeaway from where rates are going, where, again, this 10-year, it's been stuck in a range for now 2 years?
Yeah, so I concur with you that we are range bound. Mostly, let's just put the bulk of the year between 4.10 and 4.6%. And I think right now that's kind of where things are. And there isn't a heck of a lot to do. This week's high, actually, just from a technical point of view, bumped up and has fallen from the downtrend line from January's high in yields, which was about 4.8%, something like that. And I think we're kind of range bound. One of my institutional clients runs a very substantial fixed income portfolio for a mutual fund. And we're in constant touch. And I'm just telling him it's all kind of range trading. There's no big macro play to put on right now. There are some unfilled gaps on the downside in the US 10-year. One is at about 3.87%, and a few ticks beneath that. And then there's one even lower and under 3.8%. There's nothing on the upside. There's no unfilled gaps on the upside. So there's no particular bias right here, other than a very, very long-term bias that the bull market in bonds that existed from 1980 to 2020 is over, and that yields should probably move higher over time, just based upon some type of return to a more doable equilibrium price, which could easily be more towards kind of the, let's call it, I don't know, 5.5 to 6.25% range for the US 10-year. For now, it was in early April where the bonds had a chance to really break in yield terms. The day of, or the day after the low, got again one of those countertrend signals. The same thing that's showing up in the spiders now on the upside is yields headed on the downside, and that was the low of the move. And from that low, a week later, we went from, I don't know, what was it, under 4. We got to, I think, 3.9% or so low. And a week later, we were up at 4.6%. So a monster upside yield move. Pull back to about 410. And then we've topped again at, I don't know, 455 or so, just even yesterday, and, have pulled back. I'll tell you that fixed income traders and people, professionals on that side of the market are kind of dumbfounded over what's gone on. And in traditional Wall Street terms, fixed income players are considered the smart money on Wall Street. In other words, the bond market is the smartest market as far as laying out the scenario for the economy, not equity people, but bond people. And if they're confounded, then it kind of begs the question of everything else that relates to where bond prices are and what's going on there. How much of that can one actually trust when the players in the bond market themselves are very unsure of what's going on?
That's a very good point, Rick. Also, I think just crazy to see that these levels, this range that the 10 year is trading in, we haven't seen this for 20 years. The last time the 10 year was trading in around this level for a prolonged period of time was 20 plus years ago. But Rick, again, globally, the 10 year paying out in the US, let's say 4.5% ish. Globally, that's pretty high. How do you see the rest of the world looking at the US bond market right now as, again, kind of with that trade away from America narrative? We heard that other countries were selling down their bonds. There wasn't going to be that support from international investors.
Yeah, well, but think about, Corey, when was the talk of that at its height? Early April.
Liberation Day.
Yep. So we've got higher yields in both relative terms to other places, which definitely keeps money in the US because they want that yield. The dollar broke down and then came right back. And if it's this is really something. If you pull up a weekly chart of the US dollar index, the false breakout to the upside went about, I don't know, 200 pips or 2 full points in the dollar index above what had been a range trading for a couple of years. Broke out to the upside earlier this year. And then, of course, everything faded. And then it broke back into the range. And then it broke under 199 to do the exact same approximately 2-point move beneath what had been the lows of the range, only to come right back into it now. So the dollar still holds up. It's not as good as it was earlier this year, but it's still hanging in there. And this also means that both rates and the dollar are higher than where the president of the United States wants them to be. And he, of course, Trump has been pressuring Fed Chair Powell to lower rates. I am very glad that Powell has kept to not doing anything. I think it's a dangerous move to lower rates because of pressure as compared to what the economy needs. And I think if the Fed were to lower rates with the economy growing the way it is, it would really be problematic, and the rate structure would change all for the worse. So you've got a market that, the dollar is still range bound with a false breakout and a false breakdown, and now towards the lower end of the range, but still within the range. Yields are in the range. The only thing that really has, seen a huge change is the stock market. But as of now, even the S&Ps still are within the range, meaning they haven't made new highs. So, it could end up being that 2025 is the pause year in lots of markets.
When you say pause, do you mean pause and reversal from the trend?
Pause in what the prior trend had been.
But then
doesn't mean you have to kill.
Next trend?
That's the question. Some people on business TV are saying that stocks are going to fall to new lows, and the April low is gonna fall and be taken out. On my work, I have nothing that says that has to happen, because all the objectives that I was looking for in the decline were all met. So there's nothing to me that says we have to take out that low. At the same time, we don't have to make any material new high. You want to make a slight trading high to wash out some shorts that, or literally would stop themselves out above 613, you might do that. But I don't see the reason why the call from many people is that stocks need to make a new low. And some of these people making those calls are people I personally trained, hired on Wall Street and trained. I don't see it. I'm not saying it can't happen, but with the spiders sitting at 590, to say that the April lows are going to be taken out and that this is just, a wicked rally is, I think, more guesswork and, possibly makes for more for good TV, or, hey, let's be different, than it is based on sound reasoning.
Well, that's it. Has it become too trendy to jump on the negative side of the markets?
You've got a fair amount of big money, famous Wall Street hedge fund people saying that the market's going to implode. You've got some technicians saying that this rally isn't going to last, except they also said that, 500 S&P points ago. In fact, we're never bullish other than right near the lows for a quick bounce. But by the time we got back to 550, we're already negative. My directive to clients was to reduce a little I think it was the 560s, to take some trading profits because we had bought the low and the secondary test, but that there's only one place to consider shorting, and that was spiders 584 to 589, and we're slightly above that. Today's an expiration Friday. Today we get the countertrend signal. I'm willing to hold that a few more days. If we lose money, we lose 1%. If we're right, we'll make 2 to 3%, if not more. I think, if from a risk reward point of view, that's a good trade. The bigger call to say that this is a vicious bear market rally. Well, yeah, it's been vicious, and I think most of these people are underperforming this year and have not figured out what's actually going on. And surprisingly, the one group of investors who almost always gets it wrong this time got it right, which is the retail investor. Hedge funds were the ones selling in April and pushing to the downside. And the retail public was buying. And they've been right, because look at where we are relative to the all-time high. We're only a few percent away. Right? What are we, 4%, 4.5%, something like that from the all-time high? Retail got this one right. They rarely do when you have such big moves in such a short amount of time. but retail got this one right. And I think a lot of professional money managers are on the wrong side this year, sold too low, reduced too soon, and didn't realize that roughly the 610 to 580 range, 610 to 480, sorry, was what could be foreseen well before we ever got there, and what, is the likely range. And I'm not saying this range is going to last the rest of this year. We still have more than 50% of the year to go. Too much can happen. But for now, to try to guesstimate or play for new lows coming, if that's the case, if you really believe that, you should be 0% invested in equities. And that generally is a very poor decision to make.
All right, Rick, that's a lot to take in for these markets. Let's move to commodities. Let's talk gold. Since we last chatted, gold was around 3,200. Again, just over a month ago, ran up to 3,500. Now it's right back to 3,200. What's your takeaway just from the trading in the gold market?
Okay, so a few things. First off, coming into today, if I were to ask you what percent of investors do you think are bullish gold, from anywhere from 0% bullish to 100% bullish, what do you think the answer would, where do you think that is on the scale of things, given what's been a fairly bullish move?
I'm glad you asked, because this is what I've been pointing to. A Bank of America survey, a Gallup poll. Americans, it seems like, have been on this gold trade. The most recent Gallup poll, Americans are favoring gold over stocks long term.
Okay, but what percent? Where do you think we are?
The most recent from the Gallup poll, 23% said the gold is the best long-term investment. I assume quite a few people are bullish gold.
So gold has been a phenomenal investment since the year 2000, if we want to just use that as, kind of a good starting point. It has tracked the performance of the S&P, not year to year, but collectively. You've made as much money in gold as you have for the last 25 years being in stocks, which is a phenomenal thing for gold, because gold is supposed to be the hedge. So you'd never expect it to move along with such a massive bull market like we've seen since, March of 2000, which was the breakdown of the tech bubble into the '03 low. Gold has done phenomenally well. As of today, 63% of investors, now this is a short-term poll, not like you were referring to, but 63% are bullish, and that's up 8% from the day before. It topped this year around, let me look, actually I can tell you, because it was well higher than this. Let me see, the high this year in 85% bulls at the peak, which lined up with the April high. So since the April high, you have lower high and lower low. So you have a downward channel, which potentially can be a flag and just a continuation pattern in a bigger, more bullish move. Lows today and yesterday intersected the 50-day moving average, so there is some support there. And you've got resistance now at 33.65 or so would be the first resistance level for COMEX gold, for front month gold, which I assume it would be June gold. And if we take out this 50-day moving average, then we open the door for a move that can get to, I don't know, I'll call it, as in a worst case scenario, probably 28.50 or so, something like that. I lightened some gold a little too early this year at 2,700. I put it back on at 20, where was it? I think 28.50. And I'm still holding the bulk of it. And it's been a great long-term investment. It's held up well with the dollar, even when the dollar went up. It held up well. And when the dollar came off, gold actually has come off with the dollar coming off. It's been more kind of risk on, risk off with stocks as they moved, and which is not what you typically would see. But, yesterday made the low of the move when stocks pretty much made the high of the move. So they have been going, they're back and going opposite direction. Um, Long term, the targets for gold, I've got something right near 37.50 and then 40.50. And that's where I'd be apt to, again, reduce my gold holdings.
So again, this gold market, it has been strong. What is your takeaway though from all these surveys that we're seeing? Just how on board it seems like investors have been in gold, and also considering all the bank forecasts, analyst forecasts that have almost been chasing this price higher. Many forecasts now say that gold will be this year, next year, over $3,000, even higher than that.
Well, look, we're over it now, so that's just saying we'll be flat, that it'll hold up. I think what the more important question now is, can gold keep doing what it's done for these years? Is this still a long-term hold where gold will increase value over time? And my guess is it probably can still make its way higher, but from where we are, you could be as much as close to a 50-50 risk to reward. So if you first buy gold now, let's just say round numbers, $3,200 an ounce, your downside risk before you find what should be longer term support is equal to, if not even slightly more than what the upside target is to get to 4,050. And right now, I don't have anything above 4,050 as a meaningful target. So I think it may be a hold, and I'm going to hold mine, and I would probably buy some more if we got down to some of the levels I mentioned, and it sells off 10% or more. But from in here now, I'm kind of this. I can't buy gold at $3,200 an ounce now and just think that I'm going to get away with it simply because of the momentum that we've seen the last few years to the upside. Like most markets, you have to buy when there's blood in the streets. And gold, gave plenty of times that has occurred. Even back to, December of 2015 is when I put on the bulk of my gold longs. So I wasn't really involved in gold before that, but that's when I started buying gold. And that's when we had broken down. We had come from an all-time high of just shy of, I think it was maybe 1850 an ounce or something like that. And we got down to 1100 or so an ounce. That's when I first started buying. And this is what I've done for over 40 years on Wall Street, and why I have the clients I do, is being able to identify counter trend, the end of a trend before it's obvious to everyone else, so that you can get on board and then let everybody else do the work for you by pushing things higher that you're already into, and you don't have to chase something that's moving higher. Because once you start doing that, your risk reward changes dramatically. Think about this. Let's just make up stock. XYZ is trading at $100 a share. And let's say now it sells down to 80. And you have support between 78 and 82. So you're kind of into a decent support range. But the stock's down 20% and everybody's saying you're in a bear market. If you pay 80, and if it gets down to, let's say, 77, it's broken that important support. So you take a loss, but it's calculated risk. That's a much better buy in my eyes than paying 88, saying, oh, look, it held support at 80. It's moving higher. It's trending upward now. Let's buy it at 88. Because if you pay 88, where do you stop yourself out? There's nowhere to stop yourself out until it takes out the recent low. So from a risk reward point of view, what I do and what I get my clients to do is to buy stuff that looks like crap, but there's a real good reason at the time and place to buy what we're buying. And then we do the same thing on the upside. We sell stuff. How is it that 6 months before we ever got there, I told you and your listeners that if spiders ever got to 609, you want to materially reduce your equity holdings? It's because I could see in advance where there was very good chance that the market was not going to be able to take that level out with any oomph. And that gave people months of advance warning to shift a portfolio and do what they needed to do. A person who came out in February and said, oh, sell the spiders, they look toppy. How much do you think a professional portfolio manager is going to do or could possibly do? Because somebody, even if they perfectly timed it to the day that made the all-time high, how much do you think they're going to do? And how much do you think they can shift a portfolio? When you're a professional, it's different for an individual investor. But when you're running a mutual fund, let's say, with billions and billions of dollars, you can't just say, oh, today I'm going to sell the S&P. You need weeks and months of time to make that happen, to materially shift, because the amount of shares they hold in a name are huge. They can't just say, oh, dear Mr. Broker on Wall Street, dear Goldman Sachs, sell me 50 million shares of Apple today. You think that can be done? It can't. Not without complete disruption in the stock price. They need weeks to flip things. You have to be able to see in advance where numbers and models are going to suggest that you need to do something even before it ever gets there. It's, you have to be able to plan in advance what you're going to do. And a lot of times it's the hardest. I'll give you a stock that I'm still beating myself up on because I had it all lined up before it ever got there. There was a tech stock with the ticker MNDY, Monday. And it happens, it's a software company, it's an Israeli software company that before we ever got there, I told a dear friend of mine, I'm going to put in a bid at 202, which was about a buck and a half above where all the models suggested it could get to. And if it did, you wanted to be a buyer. And it got down to, I think, 200 and change on the April low. And the night before, I canceled the bid because I had bought some other things. And I said, oh, if this thing falls apart. Meanwhile, it was the exact low, and now it's a $300 stock a month later. It's a 50% move in a month. That was all lined up. And this one I happened to chicken out of only because I had bought a lot of other tech names down there. And of course, it's always hardest buying when the world looks like it's falling apart. But it's that type kind of homework and analysis and things that you need to do beforehand, and you put your orders in. And I'm very honest with you. I killed it the night before simply because I had bought other names, and I said, I've just bought a lot of tech, so I killed it. And I'm sorry I did, but the reason I'm saying this is, with the right modeling, you can figure out better than 90% of Wall Street when and where a security could very likely change direction if you've got to have the right models. And I can tell you the models they use are quite sophisticated and not, generally what people are looking at. And it does allow you to actually create alpha. The one thing that people want on Wall Street is alpha, which translates into outperformance of, a benchmark index. If you're buy and hold, the S&P has just turned positive on the year within the last week or so. Look at the difference of your performance versus having sold at 609 and bought some back at 547 and the rest at 482. It's night and day. Now, is it for everyone? Of course not. A lot of people, most people don't have the ability to do that. That's why I have the newsletters I do available. Besides my institutional client base, that's why I created InTheNoTrader.com. is to give clients, retail clients, access to some of the most sophisticated modeling on the street that I have been using now since 1995. So 30 years. There's very few people on the street who have used these models longer than I have. And it makes a world of difference in how you play this game. Some people, they're very happy to just get the benchmark return because over time, stocks make you money and people say, oh, my broker, I've done very well with my broker. He's made me money. Well, guess what? You could have done the same thing if you just bought spiders and held them for 20 years. He didn't do anything for you. He just perhaps kept you in the market. But if you're a buy and hold person anyway, and all you do is use dips to buy more, you could have done the same thing and saved yourself a boatload of money instead of paying a broker 1% a year. You don't realize how much that 1% adds up to over 40 years. If you're somebody in your 30s and you say, oh, I'm going to use Merrill Lynch, I'm going to use Goldman Sachs, Morgan Stanley, it doesn't matter, right? My broker is doing my UBS broker, right? If all they're doing is putting you into a 60-40 or 70-30 split, which you could do yourself using spiders and Qs to get equity exposure and BND and some other ones and TLT to get bond exposure, you could do the same thing yourself and save yourself an incredible amount of money.
Well, Rick, final comments then. Just a couple more commodities, whichever one you want to take here. Oil, it had a breakdown, recovered. It went to a low of about 56, recovered to about $64 a barrel, has now turned back down. Copper's been range bound. Anything else in the commodity sector before I get you out of here?
I mean, for those, oil has been very tough for traders. The one thing I'll tell you is that the theoretical overhead supply is just huge because even though we have a double bottom at, I don't know, what is it, $55 a barrel, something like that, we've come twice now to about 64. So we have double bottom, double top, and this is where it broke down from. But just pull up a crude oil chart that goes back, whether it's a daily chart that goes back a couple of years. People don't realize oil got to $133 a barrel at the beginning of the Ukraine-Russia war. And it's been down. It's not straight down, but, over time, it's just been down since, to the fact that if you go back 1 year, there's over 90% of all people who bought oil are underwater. So that to me just says, unless you're, a day trader, somebody who's trying to play every little nook and cranny, the reality is there is massive overhead supply because people are stuck higher. And if you look at the ETFs for the two key ETFs for, energy, not including XLE, which is just general, but let's say OIH and XOP, oil services holders and energy and gas. These charts, they have bottoms in place, but they have massive overhead supply. I don't think you get anywhere trying to make money in the energy space, at least on the oil side. The one thing I think that there's maybe there'll be one last chance opportunity to play is natural gas. It recently got a double bottom at $3. It peaked at, I don't know, 380 or something like that, even over the last week or two. And I think there's one more chance that maybe this thing gets down to, I don't know, $2.80 to $2.50. And that would be kind of the last place and last time I would probably take an attempt to buy natural gas for a potentially bigger move over time. But, the thing about natural gas is if you trade the commodity, if it's in contango, you lose money rolling it each month. So that's no good because you keep buying a higher price contract than what you're selling out of. UNG, the ETF that tracks it, loses the contango in its pricing structure. So that's no good. So you really need to find quality names, equity names that have more exposure to the natural gas side than, let's say, the oil side. And those are potential candidates to buy. But in general, energy is a horrible sector to invest in for the long term. And basically, you've made, since XLE and these SPDR ETFs started trading, I think it was in the year 2000, you've made absolutely no money versus the S&P. So it is the only sector to not have gained value. So that's just a parting thought for all of those who love your Exxon and your Chevrons and all that stuff. You make absolutely you don't make a penny of alpha being in those names, and some of them you just simply don't make money at all. Which makes me think of here's a final thought. Automobile stocks generally terrible. So if you go back 100 years and you bought a share of Ford and you adjust for inflation, you're up precisely $0 in 100 years after inflation. There are just certain parts of the market that are not good investments. And generally, energy is not, and car makers are not. And I don't put Tesla in car maker because that's really a technology firm and an AI firm. It just happens to bring it to the public through a car, but that's not what they really are.
So fascinating, Rick. Thank you, as always, for your time. I take in a lot from these conversations, and we cover a lot in these conversations. Wide range of markets here, and really that takeaway of what 2025 could be for markets, a pause in trends, and then what the next trend might be. Who knows what that is, but we chat on a monthly basis, and I will definitely be getting updates from you when we turn the calendar over into June. Again, if you want to follow along with Rick, especially on that retail individual side of things, visit the In the Know Trader, which I will link to in the show notes. Rick, thanks for your time on this weekend show. Greatly appreciate it.
Corey, thanks for having me.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report and wrapping up the show with me, another generalist investor that we talk to on almost a weekly basis is Joel Elconin. He is the co-host of the PreMarket Prep Show. You can also check out the PreMarket Prep website and visit his new website, the Stock Trader Network. Again, Joel is a very active trader in these markets, closely watching day-to-day, week-to-week moves, as well as the data that comes out. And Joel, look, we'll stay big picture here, but I do want to start with some of the recent data. We've gotten a lot of inflation data from the U.S., and quite frankly, inflation seems more or less, in my eyes, stuck, a little below the 3% level. Really depends how you watch this data. I think the people that think inflation is going to continue higher, they're saying that the Fed's screwed and they can't get it back to 2%. But the fact of the matter is inflation really does seem flat. I get that it's not at 2%, but it's also not skyrocketing higher. There is also that argument that's saying just wait for the upcoming months as tariffs roll through and start to get priced in. However, there's so many different components that play into that data that it can sometimes net out being neutral. So, Joel, what's your takeaway from this inflation in the U.S. really just hanging around slightly below that 3% level?
The market, first of all, good afternoon. Thanks for having me. Always enjoy being on the KE report. Silver lining market, Corey, even with some of the earnings reports we'll get to later on. But the data was the data, and it was the expected drop in the CPI was a welcome surprise in the markets. They did do a little bit of an adjusting, so it wasn't quite as much. PPI being benign as well. So right now, at the point after the volatility that we've had in there earlier in the year, people are not being alarmed. They're taking the data at face value. And until otherwise notified, inflation is something that I won't say it's a thing of the past, but it's less of a concern for investors.
Feel like we're all just waiting to see what the next trend is, for this inflation data. Is it going to trickle lower? Is it going to start moving higher? A lot of people focus on, yes, inflation, what prices are going up. What about the deflationary side of things, Joel? Anything you're seeing in terms of prices, costs the deflation, things going down?
Well, I mean, I think one of your primary components in inflation, and it's tied to a lot of different things, is oil. And oil is holding out at lower levels that you've seen over a long period of time. And that has a spillover effect, right? There's a spillover effect to the consumer. If they're spending less money, at the pump, well, then they can, go out and get that extra dinner at their favorite restaurant. So that's deflationary. The government definitely cutting back spending, right? So that's a deflationary impact, and also cutting jobs. So there are things that are going on on there that could potentially offset these tariffs. But the problem is that we don't know what the tariffs are. We don't know when they're going to take place, and we don't know how long that's going to take for that to show up in the data. So you got your deflationary things going on. You just have the unknown. And right now at this point, investors are like, hey, I got to the party's roaring, I'm not leaving.
So what about those comments from Walmart, though? Their CEO coming out saying that higher prices are coming.
Yeah, now, I mean, if you couldn't get any more of a downer than the Walmart CEO flat out coming out and saying, hey, I don't see how prices are going to stay the same in this environment. I don't know how suppliers are going to keep their warehouses full, and we are not going to be able to absorb those costs, and we're going to pass it on to the consumer. Well, they hit the stock and it came back. So, like I said at the top, it's just a silver lining market. And until otherwise notified, inflation is trending lower, steady, not necessarily looking for any major rate cuts, but you have a Goldilocks scenario in the market right now.
So taking that into account, that silver lining market, Goldilocks scenario for the markets. No one was saying that a little over a month ago after Liberation Day, but it seems like the trade talks, they have completely switched from more tariffs to now more trade deals. So how do you balance out, again, Walmart's comments that higher prices are coming, but now with these so-called trade deals being done?
Well, I mean, you hear the deals. I mean, that's the other thing too for these, over the last couple of days. There's been huge buy imbalances on the close, and managers that, miss buying the dip are having to buy the rip, and just anticipation of, more deals being announced over the weekend. I think if you take at face value what the China deal was, I mean, 30% tariffs is still going to put a huge burden on our economy. So the market, go back to using that term silver lining, the market is taking the bits of information and construing it in a positive way, whether it is or not.
But how much do we need to look forward? Everyone's saying all this data we're getting it's obviously backward looking, and a lot of this data was coming out as these tariffs were maybe just being announced, or even before they were even announced. A lot of the bears, I think, are saying just wait for the upcoming few months, especially the few quarters, for all this negative sentiment and the bearish outlook to more come to fruition. What do you have to say to all the bears out there?
You got to be in it to win it. Yeah. And I think that's why this rally has continued, is because of the people that have taken that position, that are underinvested and now are just scrambling to get back into the market. So, it's okay to be wrong, but it's not okay to stay wrong. And I think some of these managers, that dip was so quick and so violent that they really didn't have a chance. If they sold, they're really in bad shape. If they didn't have the ability to buy or buy more, they're in bad shape too. So they're just caught in a predicament here where they have to show performance, they have to show ownership, and they're being raced by high frequency traders or elbow sniffers or anything of that nature, and they're out getting ahead of their bids. So you can be as bearish if you want, but if the market keeps going up, I guess what you would be a little bit concerned about is if you do the next deal, you get the big pop and then you get the fade. That would be the thing that maybe might indicate a turn in the market.
To your point about these fund managers, money managers being underinvested in this, something that my last guest, Rick Bensinger, brought up is that this recent rally, it's been the retail, the individual investor that has been on board. Usually they're considered the dumb money that is on the wrong side of the trade. What do you take away from, again, the individual, the so-called dumb money being right, at least so far in this rebound?
I mean, that's one thing that's it's changed dramatically, really, since COVID is that, the advent of the retail investor and, the disregard for valuations and all about the momentum trade. And right now, the algos are programmed that way to go with the momentum. The retail's programmed to go with the momentum. So that, that's going to continue. You have the retail kind of getting out ahead of the institutions and buying these things and buying options, and then it's kind of the tail wagging the dog. So you can't discount the retail impact on the smart environment. And I know retail throw a lot of money into the market during that dip, so it makes it harder for the larger investor to move in and out when you have a very active retail crowd. And they love it. They love it. They love buying stocks, and they're not caring about the valuations.
Yeah, still want to be long. Hey, still that bias to the upside. Now, as much as U.S. markets have rebounded after the whole Liberation Day plummet, so have international markets. And I'm seeing European markets, especially, move to even higher levels than they were at pre-Liberation Day, exceeding what the U.S. markets have done. What's that environment telling you?
They're taking one of our book and lowering rates and quantitative easing and pouring money into their economies. I mean, I think that, it was made apparent by the current administration that, they're going to have to spend more on defense. They're going to have to spend more to prop up their economies. It's not, it's not going to all be coming from the U.S. So while our rates are going up, theirs are coming down and providing stimulus. So it's just as simple as, what's going on in the monetary system. And, we built up one hell of a rally and foundation on quantitative easing. Maybe they're taking one of the page out of our book.
So, Joel, let's move over to the commodities then. Look, gold is fading from its highs of 3,500. It's right now around 32, just under 3,200. Copper remains very much range bound, right in the mid $4 range. Oil had that breakdown, hasn't quite made it back to that range that it's been trading in for a few years now, and looks like it might be fading a little bit lower as we end the week. Natural gas, that's also very much in the middle of its range. Anything on the commodity front that's really standing out to you?
No, not really. Not really. I mean, you're seeing the exit out of gold, back to a risk on market, risk on in equities. So you have to be careful. There's been a historic run in the gold market. Silver never really followed suit. And, some of your other commodities are stable. So, it's back into the high beta, high risk Bitcoin, stocks, and commodities have had their run and probably seen a rotation out of those stocks back into the market.
You mentioned Bitcoin. Let's talk Bitcoin because back above 100,000 as we're recording this, right around 104,000. It's been a strong rebound. We've heard a little bit more of Bitcoin in the news, but hey, look, Liberation Day again seemed like it was a great buying opportunity for the Bitcoin bulls. Any targets you have from your technical analysis?
When you go to Bitcoin, I mean, I like to look at the futures and it's still off the all-time high. I'm just looking at these futures. It looks like you got a pesky level at 105,000. It hit it in 4 of the last 5 sessions. So, it's resistance until it's taken out. But after that, you got some room above that. But definitely a pause in the action at 105,000 in the futures.
All right, so Joe, let's talk individual names. There are a lot of earnings reports have now already been released on the earnings front. What's been your takeaway from this Q1 earnings season?
Not bad. Not bad. I mean, The stocks that, were trading at all-time highs and stuff that didn't blow away, took a little bit of a haircut. The stocks that, had rallies off the lows, but, needed momentum to continue. Those that were knocked down were bought back up. So it's just a market environment that they're in here where, even when these stocks, the tech stocks are, a lot of, AI related, when they're hit, you're finding buyers. So, early season, okay. Some showed guidance, others didn't. But the buy the dip mentality is alive and well.
Anything else standing out to you then, Joel, in terms of where investors are positioning in individual names?
No. We're through earnings season. We do have retail earnings season come up, so we will find out the temperament of the consumer. So that's something to keep an eye on. We're through the monthly options expiration. Today is actually the third Friday. So, now, I don't want to, if you want to go all the way to, July 3rd and Liberation Day, the next announcements here. But there's really, Trump is, not providing any negative catalyst to the market. And if anything, is providing the opposite.
Yeah, what a shift it has been in just over a month. One other thing we were talking about off mic are 13 Fs. So institutional investors needing to reveal if they have a 10% or greater stake in any companies. Those have been coming out. What have you been seeing on the 13F front?
Well, the 13F front is very interesting here. And just a note to your investors, Warren Buffett is really the one that's important. And especially when he takes a new stake. He didn't take any new stakes, but he substantially added to Constellation Brands, which is having a good day. He also added substantially the pool, which is up and at near the highs of the session. He sold out of his Citigroup. He got flat as Citigroup. The two takeaways, of course, Warren is the one to pay the most attention to. My two primary takeaways from the 13Fs were a move by NVIDIA. NVIDIA, very active investors, and they took a big stake in CoreWeave, a new IPO, and that stock chopped around pretty good off its earnings here. But what a vote of confidence here from NVIDIA. The stock is up 26% today, $17, blasting to a new all-time high. So that's something to keep an eye on, not only when the big fund managers make investments, but companies as well, one of them being NVIDIA, which is pretty well-run company. I think the most interesting thing of the 13Fs has to be the move by Michael Burry. We all know Michael from the Big Short. Sold out a lot of his positions, Baba and Baidu, and I can't think of the other things he had. And he doubled his position in Estee Lauder, which peaked at nearly $400 in 2022. Bottom last month at 48.37. So you talk about diversification, don't talk to Michael Burry about it. He's all in on Estee Lauder.
We'll leave it there, Joel. Great chatting with you. Thanks for joining us on this weekend show. Again, Joel Elconin, co-host of the PreMarket Prep Show. Check out that website as well as the Stock Trader Network. And everyone, thanks for tuning in to this weekend show. Kept this weekend show a little bit more general, trying to make sense of these market moves and the trends that were very negative a month and a half ago, let's say, that seem to have shifted course a little bit. Very much a question mark where the next trends come from, but the narrative out of the current administration also very different than what we were hearing at the beginning of April. That carries a lot of weight in these markets, and it's something that can also shift very quickly. Even though these markets haven't gotten back up to those all-time highs, they are so close. Everyone, please be sure to go back through our website, kereport.com. Also, subscribe on your podcast player to the KE Report. Review, leave comments. It all helps us spread the word on the show. And check out our YouTube page. Again, just search the KE Report. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.